Welcome to The Explainer. So, if you're a conservative investor looking for a smart, really safe place to park your capital, you are absolutely in the right place today. We're going to take a highly focused journey into an alternative that's just been quietly, steadily gaining traction against traditional debt funds. We are unpacking the Mirae Asset Arbitrage Fund. I'll be guiding you through all the data, the strategy, and the literal mechanics of how this fund aims for low volatility capital growth. Okay, let's dive into this. Here's our roadmap. We'll cover what are arbitrage funds, unpacking Mirae Asset's performance, benchmarks and peer comparisons, risk metrics and volatility, market cap and portfolio, and finally, advantages for conservative investors. Don't worry, we're going to break all this complex financial stuff down into clear, logical steps. Section 1. What are arbitrage funds? The mechanics of risk-free profit. So, how exactly can you make profits without taking massive directional risks in a wildly unpredictable equity market? Well, to answer that, we really need to understand the concept of arbitrage. In plain English, arbitrage is basically just the simultaneous buying and selling of the exact same underlying security or its derivatives in different market segments. And why do you do this? To pocket risk-free profits. You see, these funds are literally designed to ride on market inefficiencies. Think of it like this. Imagine buying an apple at a local market for $1 and instantly selling it to a buyer at a market across the street for $1.05. You're not betting on whether the price of apples will go up or down next week, right? You're just capturing that 5-cent inefficiency right here, right now. And this brilliantly illustrates how most arbitrage funds actually operate day to day. They use what's called a cash and carry strategy. Here's how it works. Step 1. The fund buys a stock in the cash market. Step 2, at the exact same moment, they take an exactly equal short position on that very same stock in the futures market. Because they're long and short on the same asset, they're completely hedged. Then, step 3, they just pocket the price differential between the two markets. There is zero directional equity risk here because they aren't relying on the stock market going up to make their money. Moving on to Section 2, unpacking Mirae Asset's performance, the historical returns of the fund. Now, this fund launched relatively recently, back in June of 2020, but looking at its performance, what really stands out is its incredibly steady track record. As of late July 2026, if we look at the direct plan, it's generated an annualized return of 6.71% over a one-year period, and an even stronger 7.55% over a three-year period. Since its inception, it's maintained a compounded annualized growth rate of 6.24%. For a conservative investor, this is exactly what you want to see. Highly consistent, risk-adjusted returns that, frankly, don't give you whiplash. Section 3. Benchmarks and peer comparisons. How does it stack up against the rest? Now, what's really interesting about this slide is seeing the fund in context. Evaluating a fund always requires looking at the competition, right? Notice the consistency of outperformance here. Let's look at the category average on the far right. Across the board, whether it's the 1-year, 3-year, or 5-year spectrum, the Mirae Asset Arbitrage Fund's direct plan consistently beats the average fund in its category. For instance, over 3 years, it delivered 7.55% compared to the category average of 6.94%. Plus, it holds its own beautifully against its primary benchmark, the NIFTY 50 Arbitrage Total Return Index, and it even beats it slightly over that 5-year horizon. Section 4. Risk metrics and volatility. Understanding the fund's pulse. All right, we're going to transition from pure returns to the actual mechanics of risk. Now, I know statistical risk ratios can kind of feel like reading a foreign language, but let's translate them into plain English for beginners assessing long-term capital growth. This incredibly low number right here, 0.09, is the fund's beta. Beta simply measures the volatility of the scheme relative to its market benchmark. A beta of 1 means it moves exactly with the market. A beta of 0.09? Well, that means this fund barely even registers the broader market's violent swings. If the stock market suddenly drops off a cliff, this fund's pulse remains incredibly calm. Next up, we have 0.56. This number is the fund's alpha. Alpha represents the excess returns the fund manager generates relative to the market benchmark, specifically accounting for the amount of risk taken. A positive alpha means the fund is generating way more return than expected for its low-risk profile. So with an alpha of 0.56, it's clear the fund's managers are actively adding real value, well over and above just tracking the index. Finally, let's look at recent market volatility through the lens of standard deviation. Mirae Asset sits at 0.42, while the category average is 0.51. Standard deviation basically just measures how widely a fund's returns vary from its own average. A lower deviation means a much lower dispersion of returns during recent market volatility. In practical terms, it means sleeping soundly during market turmoil because the fund's performance stays within a very tight, highly predictable range. Section 5, Market Cap and Portfolio. Where is your money actually sitting?
Let's move on and see how this builds in reality. We've talked about the theory and the data, but where is your money actually sitting to create this low volatility environment? When we break down the equity market cap distribution, it really paints a picture of absolute stability. Over half of the equity exposure, 52.08% to be exact, is securely anchored in large cap stocks. We're talking massive established companies here. Mid caps make up about 38%, and small caps are kept to a minimal 9.81%. For conservative investors, this means the underlying assets being traded for those arbitrage spreads are highly liquid, major market players, which inherently reduces your structural risk.
And looking at the broader asset allocation, it is very strict. The fund generally allocates anywhere between 65 to 75% purely in arbitrage opportunities. Now, to execute these trades, they need margin money, which is exactly why 10 to 25% sits in highly secure fixed deposits. The balance sits in debt and money market instruments. Because of this strict allocation, the fund purposefully says a big no to directional risk and no to duration risk. It's really a highly engineered portfolio designed from the ground up to protect your capital. Section 6. Advantages for conservative investors. Applying the data to your wealth goals. So, the crucial point is, as we reach our final section, how does all this data apply directly to your personal wealth goals? Well, if you have an investment horizon of 3 months or more, this structure is pretty much ideal. Not only is it an excellent tax-efficient alternative to traditional debt funds, but its superior alpha and incredibly low standard deviation give it a really distinct advantage over other arbitrage mutual fund options in its category. It offers minimal risk and, again, absolutely zero directional equity risk. When you put all of these specific features together, it becomes a fantastic vehicle for your capital to work smartly and safely over the long term. Just reiterating this investor profile from Mirae Asset's own framework. If you're out there looking for regular income potential, if you want that sweet tax efficiency, and honestly, most importantly, if you want to completely avoid the stressful roller coaster of the stock market while still participating in its mechanics, well, this profile fits you perfectly. Which leaves us with one final thought to reflect on as we wrap up this explainer today. Take a quick look at the cash sitting in your portfolio right now. Is your conservative capital really working smart enough for you, or is it just quietly losing out to inflation in a standard savings account? Take some time to evaluate if an arbitrage strategy aligns with your long-term wealth generation goals. Thanks so much for joining me on the explainer today, and keep learning.